In recent years, the US stock market has been booming. The value of share prices to GDP has more than doubled from 100 to 200, and the ratio of share prices to earnings have reached levels reminiscent of a dot-com bubble back in 2001. But it's not just stocks. It seems there's a new breed of consumer with a renewed love affair with risk. Gambling by American consumers has soared 60% in the past few years. Consumer spending on gambling now over $200 billion a year. Legal changes in 2018 and technological developments have led to a booming industry. And that's just traditional gambling. Arguably the biggest roulette wheel is now on financial markets. Leveraged stocks, crypto, LETFs and meme coins. The Economist reckons Americans are placing $700 billion a year on gambling on short-term share movements. This is Ethereum, the second largest cryptocurrency after Bitcoin. It's an era of highly volatile markets. In 2022, non-fungible tokens crashed. An estimated 95% are now worth nothing. In 2022, the crypto exchange FTX also collapsed, with celebrity Sam Bankman-Fried found guilty of fraud. But these booms and busts have done seemingly nothing to reduce the appetite for risk-taking. 2024 saw more than 13 million meme coins created. They have no intrinsic value, and they depend on the power of celebrity and social media to promote them. The market is worth an estimated $100 billion, yet an estimated 97% of meme coins are dead, failing to pick up any traction. Occasionally, you might get lucky and buy early and see the value of your asset soar, but many investors who come late to the party are left nursing large losses. But it still seems an undimmed appetite to try your luck. On 17th of January this year, the Trump meme coin was introduced at just 18 cents. Within a few weeks, its value had soared to $75, a 40,000% surge. One investor who bought 2 minutes after its launch sold after 2 days and with a $110 million profit. The soaring price caused more people to want to get in on the action. Who wants to miss out on easy money? But when early investors sold, the price tumbled back down to $17. The New York Times estimate at least 810,000 investors lost a cumulative $2 billion. Meme coins are the wild west of speculative asset bubbles, all appealing to our instinct to get rich quick with minimal effort. Combined with increased demand for risky shares, assets and crypto, the American consumer is also taking on more debt. Consumer credit levels risen 30% since 2022. Now, under the Biden administration, there were efforts to regulate cryptocurrency and meme coins. But given the Trump administration's enthusiasm for digital currency, these regulations have been swept aside, and we're likely to see continued growth in these new digital assets. And it is quite possible that traditional banking and crypto will increasingly merge. Now, all the way back in the early 2000s, US house prices soared on the back of reckless mortgage lending. US mortgage companies were partying like it was the roaring 20s. When it was pointed out that house price to earnings were divorced from reality, investors had a long list of reasons why this time was different. The US always attracted capital flows, a shortage of supply, clever new financial instruments. Things were different. But the truth is, investors and mortgage dealers were carried along on a wave of euphoria, irrational exuberance. And more importantly, if there was risk, it was somebody else's problem. The main thing is you didn't want to be the one to miss out on big bonuses and rising asset prices. It seemed that prices only seemed to go one way. Even when interest rates soared and house prices began falling in 2006, Wall Street firms tried to delay the inevitable. There was almost an unspoken conspiracy amongst corporate firms and credit rating agencies to look the other way and to keep prices elevated. But whilst it may be true that the markets can stay irrational longer than you can stay solvent, the inevitable eventually happened. From late 2007 to 2009, share prices fell 50%. Lehman Brothers went bust, and sentiment switched from euphoria to fear. It was a huge global shock, and there was a real danger it could drag the global economy into depression. Interest rates were slashed, and central banks pumped trillions of dollars to maintain market liquidity. Banks were bailed out by the government. But whilst the bailouts were occurring, there was talk of never again, new regulations to avoid any repeat. But 17 years after that seminal moment, it seems a new generation is once again feeling invincible to taking on risk. Even the return of inflation and higher interest rates in 2022 didn't puncture the stock market boom. Markets have shrugged it off, and it continues to rise. So why are stocks so expensive now? Are they just a bit overvalued, or are we in bubble territory? Well, there are several factors causing money to flood into Wall Street and the new digital currency exchanges. Firstly, since 2009, the Federal Reserve created an extra $9 trillion of liquidity. It has reversed around $2 trillion of this, but that's still a lot of extra money supply in the financial markets. Secondly, there's a demographic factor. The US workforce is ageing, and as people retire, they tend to put their savings into the stock market to provide returns. Thirdly, investors are really quite bullish about the prospects of the US economy and the strong GDP growth. There's a hope that the Trump presidency will cut taxes, deregulate, and enable even higher growth, at least in the short term. Fourthly, if you know past history, when markets crash, there is an implicit assumption that the government will bail out to some extent the financial sector. It's almost like a one-way bet. If prices soar, you win. If markets crash, the government has to step in to prevent a financial meltdown. After the 1987 crash, the Federal Reserve cut interest rates, introduced open market operations. In 2008, the bailout was unprecedented. The signal is quite clear. The government will always bail out markets to some extent. Given President Trump is a big fan of the stock market and digital currencies, it's rational to assume that he would be willing to bail out finance if necessary. Also, during the pandemic, the combination of low spending and government stimulus checks caused many Americans to see a rise in their spare income. This led to more investing in the stock market. It's become almost fashionable, if that's the right word. With smartphones, you can follow your financial fortunes throughout the day. There's definitely an addictive element. The example of GameStop, promoted through Reddit, has raised awareness that the small investor can try and beat the professional investors. There's been a surge in small investors buying shares, hoping to see financial gains. Also, there's the historical fact that US share prices have risen 10% on average in the past century. Even if you buy the day before a stock market crash, if you hold shares long enough, historical trends suggest that you'll see a good return eventually. Though I would add that the past is no guarantee of the future, especially given all the different set of circumstances and lower rates of economic growth in the past decade. It's interesting also that the price of gold is rising at the same time as shares, some investors hedging their bets. In the book, This Time is Different, the authors Reinhardt and Roghoff argue that one feature of financial bubbles that occur throughout history with depressing regularity, but they say that one factor is they're often accelerated by technological innovation. And we're currently seeing many speculative bubbles in this new technology of crypto, meme coins, and leveraged exchange-traded funds. Now, basically, this is a way of leveraging movements in the stock market. With leverage, a 1% rise can lead to a, say, 3 or 4% gain for you. And the principal leverage is actually nothing new. It was a key feature of a stock market bubble of the late 1920s. Share prices were rising so much, there was so much optimism, that investors started to borrow to buy shares, and this is a way to magnify their gains with limited capital. In the short term, it led to a frenzy of buying. Share prices soared, until of course on the 28th of October 1929, share prices crashed, and the rest, as they say, is history. It took 25 years for share prices to recover their pre-1929 level. Alan Greenspan famously missed the build-up of a credit crunch, remarking, "just a bit of froth in the housing market." But another feature of bubbles that he later admitted is that they generally occurred during a period of relative stability. He almost saying he did too much of a good job to keep low inflation, strong growth, and this allowed the build-up of bubble sentiment. And there's similar things today, relatively low inflation, at least very strong economic growth. And there does seem to be a really new wave of interest in all these new risky financial assets, different forms of gambling from traditional to the digital currencies. And you could say it's not just individuals taking on more debt. The US government, of course, has seen record budget deficits, and they're almost certainly going to rise with more tax cuts coming down the line. US debt forecast to rise very sharply. But bigger question is, GDP has been rising a lot. Why are so many households not feeling the benefit of it? This video looks at the disconnect between GDP and actual living standards.